Hi, this is Raj Narayanam. I am the founder and executive chairman of Zaggle. This is the first video of the IPO series, and I bring to you a very important topic of discussion, which is going public versus private equity. The advantages of each one of them are there, and I would like to, through this video, try to explain to you what are the various advantages of each of these. In the IPO, the access to a much broader investor base is possible, and what we have seen is through retail investors, mutual fund, AIFs, HNIs, FIIs, you have a whole set of investor base you can get, and that is what we did in Zaggle. Where we had a very beautiful spread out base. We had some of the best FIIs, mutual funds who came in. Along with them, now we have a base of about 80,000 odd retail investors with us. The second important point is the enhanced brand visibility. Before going public, Zaggle had just 4 banks as partners. Today we have 14 banks as partners. Would I attribute that to just IPO? Maybe no, but it is combination of factors, and the visibility of an IPO definitely helps us. The third thing is the regulatory framework. In Zaggle, because of the structured process SEBI has laid out, we were able to go ahead and attend to each of this structured process. We came to know that we can first go for an IPO. Once that was decided, we went through the process of filing the DRHP. Post that queries came from SEBI, we answered those queries and then finally filed our RHP, and post the RHP we went public. One of the things what we are seeing in the market is public markets are attracting much higher valuations than the private market. And why is that? That is because for good quality paper, that means good quality IPOs, there is a huge demand in the market. India is a base of about 140 odd crore people, out of which about 23 odd crore people are active investors. That base is increasing day by day. You have about 20,000 crores of SIP flowing in every month, and the quest for quality paper is going high. And that is why, in my opinion, there is a higher valuation which today the public market is gaining. Versus if you look at private equity space, 1.5–2 years back, private market used to be about 1.5 to 2 times of the public market valuations. But that, because of the funding winter plus what has happened in 1.5–2 years in the public markets, has created a perception, or part reality, part perception, that public market will give you higher valuation. The other advantage what we see is the liquidity for shareholders is very, very high. Whether you hold 1 share or you hold lakhs of shares, the ability for you to liquidate your shares or your stake is much, much faster. Now coming to what is the advantages of raising money from private equity in India. Maintain control between the promoters as well as the investors. It's a very small set which is maintaining control. So majority of the equity is owned by 2 or 3 or maybe 4 or 5 investors, and in a case of a large company it could be about 20–25. The other process is that it is a much faster funding process, typically between 3 months for a due diligence and 3 months for SSHA, by which you are within a 6 months you will be able to complete the funding process. Versus compared to a public market, ideal time is about 18 months to 24 months for you to do an IPO. But the biggest advantage which you find in private equity is the support from experienced investors. Investors who have seen the market, looked at various geographies, understand your sector, your particular company and your competitors very well, are actually able to give you a guidance playbook as to how you should run the company. That, in my opinion, is collective wisdom coming together to give you a beautiful advantage in terms of running the company. and one of the very big advantages, along with experienced investors, is the exit strategy. The exit strategy, there is tremendous amount of flexibility whether you want to do the exit today, you want to do exit maybe few years later, and that advantage is a very big advantage versus compare it to a public market where one quarter has gone wrong and you might get completely washed out in the public space. To conclude, the optimal choice depends on company's stage, where you are, in what stage you are, what are your goals, which industry are you in. Next, it is not like it is mutually exclusive. A company can use both public markets and private equity at different stages of growth. However, each option involves trade-offs and risks that should be carefully evaluated before making a decision. And with this, I conclude the first video of our series called the IPO series. Thank you.